Thanks for clicking! Mortgage renewals in 2025 and 2026 continues to be a concern for Canada. This according to a release from Canada's banking regulator, OSFI.
Yeah, no Sherlock!
Indeed, this isn't the first time that we've heard warnings about the wave of renewals set to hit in the next few years, with the Bank of Canada warning of a big jump in payments, amid news that Canada's big banks are bracing for their mortgage renewal cliff. And with 60% of mortgages set to renew in 24, 25, and 26, it's obviously a reasonable concern. One shared by 76% of mortgage holders, according to a recent survey by Mortgage Professionals Canada.
First I'm hearing of it.
But when exactly and to what extent is this renewal wave going to be a problem? So what I want to do today is go over what OSFI and the Bank of Canada are saying about the upcoming renewals, do a deep dive into the data, as well as the data that I pulled myself, and then discuss some implications. We do have a big week coming up next week with the release of Canada's inflation data for the month of May, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage renewals. Onto the mortgage renewal wave. OSFI, Canada's banking regulator, brought the issue to the forefront again this week, noting that Canada's mortgage renewal remains a concern for the banking regulator. And the Bank of Canada said as much last month as well, noting that adjustable rate mortgages could see payment increases in the range of 46%, while those with 5-year fixed rates could see increases of up to 25%. Though, as we'll see later, that's not really the case for those with adjustable rate mortgages, as they've already seen their payment increases over the past few years.
I think a modicum of gratitude would not be out of line here.
Meanwhile, those with variable rate mortgages but fixed payments, those who've seen their amortization rise by 30, 40, 50, 60 years, could see their payments increase by 52% in 2025 and 61% in 2026. And all of this does paint a fairly bleak picture. But what did the numbers actually say? When exactly does this all start? First, a very brief summary of how I collected the data, as the ability of others to replicate your data is one of the main cornerstones of basic research.
I never heard of that.
First, for the mortgage rates over the past few years, I grabbed the data from Stats Canada, which gives us the average 5-year fixed mortgage rates from 2014 onward. Link in the description. Next, I downloaded all of the benchmark data from the CREA. I then plugged all that data into a mortgage calculator, added a few equations asking it to calculate minimum down payments, adding insurance onto those payments, finding out how much would be left at the end of the mortgage, and then, of course, double-check the payments on my own system just to make sure all the data was valid.
Why?
Now, onto the mortgage payments. Note that while fixed mortgage rates were doing this while the Bank of Canada was engaged in its QE program, mortgage payments on the benchmark price home were basically staying flat. Essentially, the lower rates were making up for any increase in house prices.
Yes, and we're grateful to them.
But, as we can see from late 2020 onward, those payments got pushed up on higher house prices, despite the lower rates. Yeah, remember that the next time the usual suspects tell you that lower rates is going to make housing more affordable. It might in the very, very short term, but within 1 year, payments look like this. But let's fast forward. What's owed on those terms at the end of the 5 years? Well, due to the low rates and the still relatively low prices at the beginning of 2020, we don't really start to see an upsurge in the amount owing on mortgages until May of 2025. And this is reflected in the payments on those mortgages. If we use, say, a future fixed rate of 4%, this is the increase in payments in 2025 and 2026. As we can see, payments don't really start to go up until May of 2025 and then hit their peak increase at about 20% in February of 2026. If, on the other hand, fixed rates are at 3% in the next few years, the pace of the payment increase remains relatively similar, though peaking at about 10.5% in February of 2026. As to whether or not fixed mortgage rates are going to drop to 4 or 3% over the next few years, I think it's worth noting that in the Bank of Canada's projections, they're looking at a 20% increase by 2026. Very close to our numbers, so the bank very well could be projecting a fixed mortgage rate in and around 4%. And while the bank does provide us with a roundabout number, these charts at least give us some idea of where the bank might be thinking interest rates are heading. The Bank of Canada doesn't give us a link to the market expectations data that it's using, meaning we can't replicate and assess its findings. The governor got his PhD in economics from Western University. He should know this. Be better.
What did you say?
Regardless, what these charts do tell us is when we saw the highest prices and the lowest rates during the pandemic, and is a bit more specific than just noting that payments are going up in 25 and 26. And this is also the case with uninsured mortgages as well, those with over 20% down, which, according to the Bank of Canada, those were far more likely to stretch themselves during the pandemic. Inputting the values from Stats Canada and adjusting the values for 20% down without mortgage insurance, we can see that payments start to increase in June of 2025 and hit their peak increase of about 20% in January of 2026. And that's assuming a 4% fixed mortgage rate. So for those with 20% down, their payment increases are going to be very similar for those that had less than 20. Now, this type of analysis is much more difficult to run on adjustable rates, as there's just too many interest rate changes between the time of purchase and the renewal date, which is just a bit beyond my Excel capabilities.
I mean, that guy doesn't know his from his elbow.
However, it's not overly consequential for our purposes trying to understand the renewal wave in 25 and 26, as those with adjustable rate mortgages have already seen their payments increase. With that said, I did run a few numbers through CMLS's variable rate mortgage calculator, inputting all of the Bank of Canada rate hikes over the past few years. For those who bought at the peak of the market in February of 2022, they're going to owe $721,000 at renewal in February of 2027. And even if we get 7 more cuts, if we get a total of 200 basis points worth of rate cuts between now and then, the damage has been done and they'll still owe $714,000 at renewal, which means as of the most recent release from the CREA, those homes will be underwater, or very close to it, meaning they'll owe just about what the home is worth.
I think a modicum of gratitude.
And even then, it would probably be worse than that, as realtors don't work for free and neither do lawyers. So even if those buyers owed what the home was worth, they still couldn't sell it. So we have those with fixed mortgage rates, which really start to see the increase in their payments in May of next year, though those payment increases don't peak until about January. Is a 10 or 20% increase in payments enough to make homeowners flood the market with new inventory? I'm not sure. Adjustable rate mortgage holders sure haven't flooded the market, and they've seen their payments increase by that much or more. But the real problem are these guys, those holders of variable rate mortgages where the payment doesn't change, which the Bank of Canada says could see an increase in their payments by 50% in 2025 and 60% in 2026. Those are the real worry, and although there's not much data about how much of that stuff is out there, not much aggregate data, we can triangulate. According to the Bank of Canada's 2022 Financial System Review, about 80% of variable rate mortgages have fixed payments. And as to the amount of mortgages advanced during the pandemic, we can turn again to Stats Canada, which shows us that variable rate usage shot up at the beginning of the pandemic, constituting about $10 billion per month, and stayed relatively flat until January of 2021, at which point it started to skyrocket. So if 80% of those funds that were being advanced were all fixed payments, then that's fairly considerable. But again, similar to fixed, the problem really isn't going to show up on a massive scale until January of 2026. And as a very brief side note, I do poke fun at banks and brokers for pushing variable rate mortgages, and I do that anecdotally, as I saw brokers dress down other brokers who suggested that buyers maybe should take a 5-year fix at 1.84.
You don't know what you're doing.
But we can also see these variable rates being pushed right in the data. We can see that prime didn't change over the pandemic. We can see that the discounts on that prime fell massively. So yeah, this stuff was being pushed fairly hard.
I do not recall that. I do not.
But I digress. So, in summary, we can see here right in the data that the major payment increases don't really start at the beginning of 2025. They don't really start until about midway through 2025 and then peak in 2026. Are those major payment increases alone enough to cause a major surge of inventory in the spring market of 2025?
We can only hope.
I'm not so sure. As mentioned, those with variable rate mortgages have been handling those payments just fine, for the most part. But variable rate mortgages with fixed payments, those could in fact become a problem, as there's a big difference between a 50% increase in payments and a 20% increase in payments. My guess is if we do see a problem, that is where it's going to show up. It's going to show up in all those mortgages where the homeowner hasn't been making the full payments, have seen their amortization skyrocket to 70, 80, 90 years, and upon renewal, sees that amortization snap back to its original term, which could put the payments up by a massive amount. So, just a bit of perspective today, we are seeing an increase in warnings coming out of the banking regulator, coming out of the central bank about this renewal wave. And as we've discussed before on this channel, I suspect many 2024 would-be homebuyers are waiting it out until 2025, waiting it out to see how that renewal wave materializes and if we see an upsurge of inventory coming onto the market. We still could, especially if the economy doesn't hold on, but as the data here shows, I wouldn't expect to see a major payment-caused inventory surge coming to the market at the beginning of 2025. If anything, it would be later on in the year. With that said, we will continue to track Canada's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.